Okay, ladies and gentlemen, welcome back again to our lecture on statement of cash flows. This is the second segment to our presentation on this week's topic, that is statement of cash flows. In the previous segment, we introduced the statement of cash flows, the theory surrounding uh, the reasons for the preparation of statement of cash flows, and then the presentation expected in terms of International Accounting Standard number 7, statement of cash flows. Okay, so here we are going to go through a very long exam type question which will illustrate all the nitty-gritties associated with the preparation of statements of cash flows. Okay, so this is the question, ladies and gentlemen. We are having a company, a hypothetical company called Lademwinge PLC. Okay, the draft statements of financial position as at 31 March 2023 and 2022 of Lademwinge, that is LDMG PLC, are shown below. So we are given two statements of financial position, okay, on one page. How is this possible? Yes, it is very possible because we are having two separate years. Okay, so if you cut across here, you can clearly see that the first segment here, or the first column, this first column represents the financial information for 2023. So that's a separate statement of financial position for Lademwinge for the year 2023, and this one is for the year 2022. So you need to visualize your statement of financial position this way. These are two statements of financial position. What do we have in these statements? We are having non-current assets, okay, and in these non-current assets we have got two groups. We have got intangible assets, okay, and these are the values for respective years. Then we have got property, plant and equipment, and these are the values. We also have current assets with a breakdown of inventories, receivables, cash, and on your right side, those are the values for each respective year. The statements of financial position continue. Okay, we are having the equity, and we have got the ordinary shares of $1 each, and these are the values for 2023 and 2022. Then retained earnings for 2023, 2022. Other components of equity, we've got share premium account, 90, 70 for the respective years. Excuse me. Revaluation surplus, we have got 170 in 2023 and then 0 in 2022. And these are the respective totals. Okay, we move on and on. Those are the non-current liabilities, and we've got so many categories of them. Okay, we've got the 8% loan note with a maturity of 2028 as the year of maturity. Okay, then 10% redeemable preference shares. And somebody might say, oh, shares, we're having shares there. How come they are under non-current liabilities? This is because if the preference shares are redeemable, then in terms of the rules pertaining to financial instruments, they become financial liabilities. Okay, why? Because the shareholders of these shares are given priority over the ordinary shareholders of the company. So in that regard, using the substance of a form, you can see that these shares are considered a liability to the company. the dividend has to be paid whether we make profit or not. All right, so it is actually a liability to us, an unavoidable obligation. Okay, so this is why we consider them under the non-current liabilities. So the figures for the respective years are these ones. That government grants, okay, deferred tax, environmental provision, okay, and these are the total. And we move on to the current liabilities. We have got our trade payables for both years, accrued interest, bank overdraft, taxation, and government grants. And those are the totals for the current liabilities, and these are the ultimate totals for both equity and liabilities. Okay, and you need to cross-check if the totals were in balance. For remember, the accounting equation: assets is equal to equities plus liabilities. So the equities and liabilities were having these totals. Let us cross-check with the assets. We can see that the totals were balancing, they were the same. Okay, let's move on. This is now the draft statement of profit or loss for LDMG for the year to 31 March 2023. Okay, so we have got revenue, that figure, and depreciation, which was considered part of cost of sales. Remember, this column shows that the cost of sales included depreciation 366, impairment of intangible assets 36, other costs that one. Okay, and that's the composition. Like I said in my previous video, I said that sometimes depreciation is considered part of cost of sales, so you need to take care of that. Okay, and that's the total of cost of sales. This is the figure for cost of sales in total. Okay, gross profit. All right, gross profit is found by deducting cost of sales from the revenue. Okay, so this was our gross profit. Then we move on to other operating income. We have got government grants. All right, and this is the total after incorporating the government grants. Then these are the operating expenses. We have got distribution, administration, and environmental provision. Then they give us a total of 198, and if we deduct that from the 791, we are left with 593. Okay. Then you can see that could be the profit before interest and tax, and then we factor in the interest or the finance cost. Okay, we have got 12, okay, as the interest specifically from the ordinary non-current liabilities like bank loans and so forth, or debentures. But as I have indicated that the preference dividend is a liability to the company, so that particular shareholding is considered a loan. All right, and the interest is also part. And the dividend they accrue is considered a finance cost to the company. So this is why you are seeing the preference dividend as part of the finance cost. Okay, so you need to take care of that. However, in the presentation of the cash flow, the actual dividend, preference dividend, which was paid, is reported under the financing activities and not in the ordinary, in the operating activities section of the statement of cash flows. Okay, that's the normal practice, and you just have to follow that. Then we get 47 as the total of our finance costs, total. And then we have the profit before tax. Let's continue. Then we have to factor in taxation, and we are left with the profit for the year. Then there is a section for the other comprehensive income where we take the profit for the year. It should be similar as that one reported. Okay, and then other comprehensive income, that is the gain on property revaluation in this case, and then we get the total comprehensive income for the year. Then there were some additional notes which we need also to factor in. You can see that this is a rebellious, question, very long one. You need to take care of it in the exam, because that's the type of exam questions you're likely to face at this level. So you need to be prepared for such. You might not be studying ACCA per se or ACCA financial reporting paper, or you might be doing some and you might be doing some other qualification, like for example in a university bachelor's degree where accounting is also part of your subject. Then this video should be for you. You need to actually go through to listen up to the end, because you never know where your luck could emanate from. This video might act as your magic wand. All right, let's proceed. Tangible non-current assets. So this is an explanation of the figures which were shown in the statement of financial position. All right, so these include land, which was revalued, giving a surplus of 120 million. So, well, we now know what was going on with the revaluation surplus, because in the previous year there was no figure related to that. Okay, if we go to our revaluation surplus here, we found that there was a zero in the previous year. In 2022 there was a zero, but in 2023 we saw a revaluation reserve of 170. So we also have to cross-check with the statement of comprehensive income to see if we are having the same figure. Yes, we are having the same 170, so we are happy, and the note is actually consequential. The company's motor vehicle haulage fleet was replaced during the year. The fleet originally cost 42 million and had been written down to 11 million at the time of its replacement. So the applicable figure here is 11 million. That is the value of disposal, because when we account for the amount of items which were disposed of, we consider the carrying amount of those items, and this was 11 million. Okay, don't worry, you'll see as I will be doing the working for property, plant and equipment, and you will see for yourself. The gross cost of the fleet replacement was 180 million, and a trade-in allowance of 14 million was given for the old vehicles, and this 14 million is actually a relevant figure here. Okay, let's proceed. The company acquired some new plant on 1 July 2022 at a cost of 120 million from Zemdai XDA. An arrangement was, so the cost of the plant acquired, remember, was 120 million. Bear that in mind. An arrangement was made on the same day for the liability for the plant to be settled by LDA Lademwinge plc issuing at par 8% loan note dated 2028 to XDR. So these guys were to buy this particular plant using a loan. Okay, so they were giving a loan, they were actually issuing some loan notes and then get the plant in exchange. Okay, so that's how they were going to finance the purchase of this plant. It was through a loan arrangement. The value by which the loan notes exceeded the liability for the plant was received from ACCA in cash. So if the loan notes were actually fetching a much larger amount, then the difference was going to be given to the acquiring company. That's what, in short, this represents. I'm sure you guys are following. Okay, so let's go to the environmental note to see what's going on. Okay, all right, just a minute. Just want to confirm if I'm still recording. Okay, it's super. We are recording. All right, I wanted to confirm if we are recording because it's very disappointing to realize that, oh, after doing everything you were not actually recording. It's very disheartening. All right, so I was explaining the last part of note one that this company LDMG acquired a plant from Shimdai, probably a Chinese or Japanese company, and the plant was costing 120 million, but they issued loan notes, 8% loan notes. That is loan notes which were fetching an annual interest of 8%. Okay, up to the year 2028. And if you still remember, we talked about this particular loan note in the statement of financial position. So let us see if the plant was costing 120, then let us see the value of the loan note. I mean the principal amount. So the principal amount of this loan note was 200. Okay, 200 million. So we are told that the examiner is telling us that whatever excess of the liability was going to be refunded. So we can see that the liability was 200 million, but the plant was 120. So the 8 million was received. So this was actually cash which was received. Are we together? So I want you to pause the video and tell me which section, in which section of the statement of profit of the statement of cash flows, or which heading, under which heading are we going to report the 80 million? Is it an investment activity? Is it a financing activity? Is it an operating activity? Please just pause the video for now. Okay, rockstars, I know you have figured that one out. Okay, this is a financing activity. Okay, that proceed of 8 million is going to be considered as a financing activity. So you need to report it under the financing activities heading. Okay, that's it. Now, the provision, the environmental provision, we are being told that the provision represents an estimate of the cost of environmental improvement relating to the company's mining activities. So you then have to go back to the statements of financial position as well as the statement of of comprehensive income for you to know much about the workings required. But don't worry, we'll show that shortly. Then lastly, ordinary share issue. During the year, the company made a bonus issue from the share premium account of one new share for every 10 shares held. One thing you need to bear in mind is that this bonus issue is a non-cash issue of shares. Okay, no movement of cash is going to happen or happened. Okay, so it was just an issue of shares to the ordinary shareholders to motivate them, okay, to give them a thank you for being part of the company's shareholding, okay, but it does not result in a cash movement. Are we together? Okay, so you will see again as we'll be doing the workings. Then later, LDMG PLC made a further share issue for cash. Now this one was a share issue for cash, and your job is to determine how much was the cash received from this further issue of shares. You need to compute that, and we are going to show you step by step. Then a dividend of 220 million was paid during the year, and specifically this was a dividend paid during the year, and you need to determine where you're going to report that dividend. Okay, so we are going to show you everything step by step. Then you're also told that the preference share, dividend was paid during the year, and you know which statement of financial, which statement reported this preference dividend, and you can remember that this was the statement of comprehensive income. If you still remember, okay, this is where I was talking about the issue. This is the statement of comprehensive income, or the statement of the statement of profit or loss and other comprehensive income. So that's where, so they are simply saying that this 35 million you are seeing there was fully paid. Your job is to identify in which section of the statement of cash flows am I going to report that. Is it in the investing activities or in the financing activities? You need to figure that one out. Wonderful. Yes, a clever student has already figured out that the preference dividend, although it is part of the finance costs, it is reported in the financing activity of the statement of cash flows and not in the operating activity section. Okay, where its counterpart, loan net interest or the interest paid, is going to be reported under. Okay, so let's then proceed. We are going to start with the common rules. The common rule is that you just need to do a little bit of some workings before you just crash into your statement of cash flow. However, there are certain informations. There is a certain information you need to just know that you just have to pick and plug in. For example, the profit before tax is just going to be an easy figure for you. Just have to take that one and plug it into your statement of cash flow. All right. But because of the issue of chronology of presentation, I'm going to start with workings and not the statement of cash flows per se. Okay, so let's start with our workings, and I'm sure the workings are going to fit on this one page. Okay, so let me just say workings. Working number one. The working number one we need to do, ladies and gentlemen, is the interest paid. Okay, the question that comes into my mind at this point is that what particular heading shall I give to this working? Okay, the safest heading should be finance costs. I know at the back of my mind that there are two types of finance costs. We have got the normal finance costs as well as the preference dividend. Okay, so I want a topic or a heading that would give me enough leverage in doing my working. If I restrict myself to just say interest paid, then what about the dividends that was paid? Something like that. Okay, it might confuse me uh, on the way. So I want a heading that would reflect the flexibility I need. So that being said, let's then continue. We know from our statements of financial position that uh, there was information relating to interest payable. Okay, all right. So, but we don't have uh, information relating to dividend payable. Preference dividend payable. All right, on our current liabilities there. So, we are safe. We are only going to check uh, information relating to the interest. Okay, so the opening balance was 0, but the closing was 4. So we slot in that information to our first working. So we have got balance BD, that is the opening balance. There was a 0, okay, and the balance CD was 4. Okay, we know that information. Then we are also told that uh, there was information relating to this interest in our financials. Relating to these costs. Okay, so we are told here, let me change the pen color. We are told here that the total costs, the finance costs in total were 47. As you can see there were 47. So we have to slot in that figure. So you come here and say, from the statement of profit or loss, we are told that we incurred 47. Okay? Remember, we are in $1 million. Then we are also told that there was preference dividend, all right, which was paid. We noted that in the notes to the financial statement that the preference dividend that was due was paid. So we know that 35 was actually paid. Okay, but we are not told about how much was paid for interest. So the interest which was paid, this should be the balancing figure. And if you add 47 and minus 35, you are going to get some figure of thing is 12. Okay, you're going to get a figure of 12. However, we are told that at the end of the year, the amount outstanding of finance cost which was not paid was $4. So for 12 minus 4 should give us 8. Are we together? So the interest which was paid is supposed to be $8. And as I've already indicated, although both the preference dividend and the interest paid finance costs, their reporting in the statement of cash flows is going to be different. The preference dividend is going to be reported under the financing cost, the financing activities heading, whereas the interest paid is going to be reported under the operating activities segment. Okay, so let's move on to the next working. Okay, so it is also safe to point out that this one is going to be reported under the financing activity, whereas this one under the operating activity. All right, working number 2, taxation. So we again start with the balance brought forward, okay, and we then go to the statement of profit or loss that is charged for the year, and then we obtain a figure for the tax which was paid as our balancing figure, and then the closing tax balance. So we just follow the same pattern, okay, and we know that the opening balance was how much for tax for the year 2022. If we go to our balance sheet, or I mean the statements of financial position, you can see that we need the figures for deferred tax as well as the current taxation. Okay, so I mean the tax payable. So deferred tax was 30 in 2022 as well as 185. So we add these two as our opening balances. So 30 plus 185, that should give us something like 215. So we slot those two figures. I'm saying 30 plus 185. That gives us 215 million. Then in the statement of profit or loss, we have got a figure for tax which was 177. Okay, so we slot in 177. We need to add 177 to 215. Why? Because the 177 is the current year tax which should be added to the tax which was payable at the end of 2022. Okay, so the 177 is increasing the tax. However, it is going to be only reduced by a tax payment which was made to the authorities, but we do not know that value. But what we know is that at the end of the year, the closing tax balance was, this is the figure, these are the figures. We go to the deferred tax as well as the closing tax payable. So 52 plus 176, those are the figures we need. So we are saying the closing is 56 plus 1. Sorry, let me just. Sorry, it's 52 plus 176. 52 plus 176. So let's add those two figures. That's 228. Okay, so if we add this 215 plus 176 minus 228, we are going to get the figure which we need, and that figure is none other than 164. Please cross-check with your calculators. Okay, cross-check with your calculators. 215 plus 177 minus 228, you should be left with 164. Let's proceed to working number 3. All right, how do you know which working is going to follow? Okay, there are certain workings, like I said, which you need to know by default. You need to know your interest paid to calculate your finance cost. You also need to know your taxation. Those ones you just have to know. But some are then question specific. For example, when you look at your statements of financial position, you can then get the hint. For example, you need also to have a working for these non-current assets, okay, for the intangible assets as well as for the property, plant, and equipment. You need that those workings, okay. So let's then start with the intangible assets. Intangible assets. Okay, the intangible assets, ladies and gentlemen, they also follow the same pattern. We want the balance, the opening balance PD from the question. We also need the statement of profit or loss charge. This could be the depreciation charge, the amortization charge, or the impairment charge. And then we need some balancing figure here, which we are calculating the cash movement, right? That will give us information about certain assets which were added, certain intangible assets which were added or which were acquired, okay. So it gives us the amount which was paid to acquire those items, all right. And then remember, these are assets. We are talking of assets, okay. These are assets. They're different from the finance costs or the taxations, which were costs, but these ones are assets, okay. So this is why I'm talking of additions. Then we have got the balance CD, which is the closing balance. So the opening balance for tangible assets was how much? We are told that it was 410 and the closing was 450. So let us slot in those two figures, 410 and 450. Okay, and then let's go to the statement of profit or loss to see if there was any information relating to these intangibles. You can see that this is the information we need. Okay, 36 million as the impairment of intangibles. So there was 36. Okay, this was a deduction to our asset balance. Okay, it's a negative. All right, like I said, remember that we are now doing a working related to assets. It's different from a working on expenses like finance costs. The treatment is a bit different. Okay, good. So that's it. Excuse me. Now, if we had 410 worth of intangibles at the start of the year, and then they were reduced by an impairment, what would be the balance if the closing balance was 450? So it means there was, because if you say 410 minus 3 minus 36, let me use my calculator here. 410 minus 36, you arrive at 374. Okay, but at the end of the year, the balance was now 450. As you can see here, it was 450. How come? So it means that there was an addition of assets of how much? From 374 to 450. That should be an increase of 76. So this balancing figure should suggest that we added something. So these being intangible assets, therefore would have purchased something like goodwill. Purchase of goodwill or other intangible assets. So goodwill purchased 76. Are we together, ladies and gentlemen? Are we together? Yeah, that's how you need to think about basic. You're not going to just walk or to stroll in the park and pass this financial reporting paper. No, it doesn't work like that. So you need to think outside, like what is going on? What is going on? Okay. So by the way, these items I'm referring to as balancing figures. This one, and these two. I mean, this amount as well as this one, because this one was expressly stated that it was paid. So those are the items which are going to be reported in the statement of cash flows. The rest there is just rubbish. Okay, it's not rubbish actually, it's something, it's material that is helping you to arrive in the intended destination. Okay, so it's not rubbish actually, it's something that is important. Okay, it might be reported in other financial statement, like for example the statement of financial position or the statement of profit or loss. Yeah, those are the items where they could be reported, but not in the statement of cash flows. Here we only report cash movements. Okay, good. Now another important working which you must not forget in the exam hall, is um, working number 4. Okay, I'm not saying it should always be on working number 4, but for this particular question, we put it on working number 4. So that's proper plant and equipment. This is a very, very, very important working. And if you just come out of the examination hall and say, I didn't do any workings for proper plant and equipment, and I'll bet with my salary you're not going to pass that paper. Why? Because that's a very common working. You cannot present to managers uh, any financial statement without the proper plant and equipment. They will ask you, did you do your accounts very well during your secondary school or during your high school? Or we do not want to put the ACCA qualification to disrepute. Okay, so let's move on. So as usual, you start with your opening balance BD. It's very simple. It's just a pattern. Okay, it's just a pattern, and you just have to be used to this particular pattern. So what was the balance brought down for property, plant, and equipment according to this? All right, let me try to erase a lot of debt here. Okay, because some of you, I know, you might end up being casualties. Uh, okay, it's refusing to be erased. Okay, don't worry. I wanted to clean up the board, but anyway. All right, so for proper plant equipment, this is the opening balance 1830 and then 2480. So let's slot in those figures to our workings. So we have got 1830. Remember, we are talking of million. There were a lot of items, so for proper plant equipment which were discussed. So I would rather leave enough space to cater for those items. And here the closing was 2480. Please cross check. We don't have time. Okay. So we then have to slot in other figures there. For example, we were told that there has been some revaluation taking place. Okay, revaluation. So that one, evaluation of land. Okay, so we talk of revaluation, which was 170. Okay, so the notes are going to assist us much here. And then the campus motor vehicle fleet was replaced, and the fleet was written down from 42 to 11. So at the time of replacement, so at the time of disposal, there were now 11 million. So disposal, 11 million. the disposal is reducing the non-current asset balance. So this is why we put it in negative, but it doesn't mean that it was a cash flow. Okay, those are not cash flows. We will arrive at the cash flow, don't worry. Okay, and we were also told that there was some depreciation. Remember, when we attended to this working for intangible assets, there was some form of depreciation we talked about. This was now the accelerated form of depreciation, that is the impairment. Okay, the ordinary depreciation for intangibles is amortization. However, when we talk of impairment now, this is now serious one. Okay, all right. So that's the idea. Okay, so we looked at the same working when we were doing the intangibles. So when you are now doing the fixed assets, then or the tangibles, you then have to also think of depreciation. Depreciation, and this was expressly given as 366 in the question under the cost of sales. Okay, so your figures are accumulating. You then have to go back to the notes and think again. The gross cost of the fleet replacement was 108 million, and a trade-in allowance of 14 million was given to the old vehicle. So the trade-in allowance of 14 million has got some impact, similar to a revaluation, similar to an addition in value. So we then put it as a trade-in value as a positive figure, 14. Okay. Okay. Then, do we still have anything we need to review again the notes to see if we still have something there? All right, the same paragraph is talking about the company acquiring some new plant on 1 July 2022 at a cost of 120 million, but this was acquired through a loan arrangement, through the issuance of loan notes or debentures. So we then have to consider the value of the items which were acquired using that system. So debenture acquired assets, okay, or plant through debentures, 120. So it's an addition to our plant. Okay, plant through debentures. Plants acquired through debentures. Okay, do we still have anything? We are done. Okay, we are done. All right, don't worry about the amount that was the amount that was received. Don't worry about that one. The excess amount. Don't worry about that for now. So we then want to see if the figure there is going to give us information of assets which were added during the year, or which were added through cash, which were purchased, or the amount of money that was paid to acquire additional assets. So this should be the balancing figure. So let's use our calculators. We've got 1830 plus 170. 1830 plus 170 minus 11 minus 366 plus 14 plus 120. We have got 17. So they give us a total of 1757. Okay, that's the total we get. But we can see that our balance at the end of the year was 2480. So it triggers us to some addition. We need to add something to reach that amount from 1757. So we say 2480 minus 1757. We can see that the addition made or required was 723. So that was the payment to acquire additional assets. Or we can call these ones additions. So in your statement of cash flows under the investing activities, you're going to say purchase of PPE or purchase of non-current assets in bracket property, plant and equipment 723. This would be a negative figure in that section. Why? Because this was an outflow. You don't get those assets for free. It means that money left the business. Okay, do we still have any other working we want to think about? Because if we don't have, if we are not very systematic, we are likely to lose the point. So you just have to go systematic. You have dealt with these workings. This working, you have done it, but this working you can put it on hold for now, okay? Because this is about working capital movement, okay? Working capital movements. We will need it, but you can do these workings when you will be doing your cash flows. But anyway, the essence here is that we just need to see whether there has been an increase or decrease, and by how much. So for example, if we started the year with inventory worth 763 but ended with inventory worth 920, then it means that there has been some increase. So you come here and say increase by how much? Increase by you say 920 minus 763, that's 157. 157, or this is a 7. And then here from 472 to 6, so it's again an increase of how much? 642 minus 472, 170. You come here. Again, another interesting aspect is the trade payables from 518 to 680. So this again was an increase. Increased by how much? 680 minus 518, that's 162. Okay, you're done with that. You're done with those ones. You move on. Okay, somebody might be asking, say, why did you leave out cash? This one, you do not have to worry about it for now. This is the reason why you are preparing your statement of cash flows. Okay, I've spoken about this in the first video. You need not to do adjustments for cash movements. Why? Because when you prepare your statement of cash flow, you would want to see how did the accountant arrive at the cash balances as reported in the statement of financial position. So you don't have to adjust for this when you will be doing your working capital movements. So the same figure again not to be adjusted for is the bank overdraft. It's also a cash figure. Okay, don't worry about that figure again. All right. So another figure that is outstanding, yes, we are seeing that there is an issue of government grants. So we need that working. Okay, government grants, these ones. So let us have a working for government grants. So that's how you determine your workings. It's not an issue of guessing. Sorry. So what was the opening balance for grants? Grants. Okay, usually grants are considered liabilities. Why? Because they usually refer to many periods, many accounting periods in future. So the amounts are systematically distributed using the matching concept. Okay, we don't have to recognize the whole income as it arrives. So we use the deferred income principle. All right, so this is why you see them being reported in the liabilities section of the statement of financial position. Okay, so the opening balance BD, like I said, this is the liability. So the opening balance includes how much here? Includes 160 and 40. 160 plus 40, that's 200, isn't it? So we have got 200 as our opening liability. Are we together? Then we go to the statement of profit or loss. Here we are going to look at the income credited. Income that was credited as income for the year. Okay. Okay, this one. 50. So we're going to say 50. But is this 50 a positive figure? No, this one is a negative figure. Why? Because it is reducing the liability. Okay? It is being credited to this current year because that's the year in which it is due. So it is reducing the grant liability. Okay? Now, remember, these are grants or assistance from the government. Okay? So when we receive the grant, like I said, we recognize it as a liability. So this is why we are saying that the opening balance was a liability. Okay? But when we then distribute this in each relevant accounting period, we will be then crediting income and debiting the liability. So this is why we are reducing it by a negative there. Okay, then we are also told that the balance CD of the liability related to the grant was how much from the statement of financial position. Okay, we have got 50 as the current grant, then 210. So 50 plus 210, this gives us 260. So 200 minus 50, we arrive at 150, but we rose to 260. what would have happened? It means that we have received grants during the year. So grants received, because ordinarily it was supposed to have to be a lesser amount, but it is increased. Okay, so how much was the increase there? From 150 to 260, that should be 110, a positive figure, and that's the amount we need to report as grants received. Is this one going to be a financing activity or an investment? Investing activity? Somebody tell me. Let me pause the video. Somebody tell me, please. Okay. As for the heading under which you need to report uh, grants received or any other item of the financial statement, you need to ask yourself the issue of relevance and faithful presentation. Representation of financial information. So, for example, if the grants if the grants were received for the purpose of financing a designated asset or an identified asset, therefore, in that case, you can be allowed to to enter the grants received under the financing activity section. However, you can also be allowed to present it under the investing activity section if it was to prepare other if it was to procure other assets. For example, if we are talking of office equipment and so forth, in that case, it can be an investing activity as well. So it's not hard and fast to say that you need to present the grants received under the financing or under the investing activities. It's all an issue of relevance of financial information. Okay, sometimes the grants might be received for things like to assist in the payment of salaries and so forth. In that case, it also becomes a specifically financing activity. Okay, so you can report it under the financing activities. Why? Because you can't say we were investing in the payment of salaries for employees. So it's an issue of relevance. Okay, the relevance of the financial information as well as the faithful representation of it. All right. So that being said, let's continue. Any other working outstanding there? The grants, we've covered them. But I saw something like the environmental provision, something like that. Yes, the provision represents an estimate of the cost of environmental improvements relating to the Kama's mining activities. So this one was actually a very important fact. So we have again that information in our SFP. Okay, this is the information we are talking about. So the opening was 24, the closing was 76. So we just need a little working. just a little working. Somewhere here. So that's working number 6. Environmental provision. Okay, this might look very easy, but you will discover that working can be problematic. Okay, as usual, we start with the opening balance, and we say that it was 24. The closing was 76, if you still remember. So, as usual, we go to the statement of profit or loss to look for the charge to the income statement during the year. We are told that it was 67. Then we need some balancing figure there. Okay, 24 plus 67, this gives us 1191. Okay, it gives us 91. However, we have gone down to 76 at the end of the year, which means remember, the provision is a liability, and when we incur a charge again, it means the liability was increased to 91. However, it was reduced to 76 at the end of the year, which means we would have paid something. So cash paid to settle the liability should be the difference. The cash paid to settle the liability. Okay, so we would have paid 15 million, and that's an amount we need to account for in our statement of cash flow. What about the loans? We talked of the loans which were issued. We also talked about the shares which were issued. The debentures. At the start of the year, we had how much? At the start of the year, we had 0, but we ended up having 200. So let us write something about that. There was 0, but at the end we had 200. Okay, all right, and this loan was used to acquire some assets. Okay, the acquisition of PPE, which was how much? If you still remember, it was 120 million. Please refer to the note 1. Okay, so remember, the acquisition was not made through an exchange of cash. However, we were told that although the loan was for the amount of 200 million, the plant which was financed by this loan was worth 120, but we were told that the difference was supposed to be paid by the selling company. Okay, we gave them the 200 worth debentures. Okay, the 200 worth debentures. So they were supposed to give us the change of 8 million. So the difference here should be the proceeds. They did not give us the full 200 million, but they gave us partly in the PPE, okay, partly in the plant which was acquired, and the 8 million change. So the actual proceeds, the actual cash we received was 8 million proceeds from issue of loan notes. Okay, so the 8 million being the balance figure. So that's the amount we have to report in the statement of cash flows. Then we had an aspect of share issues. Issue of shares. The issue of shares. We have the balance BD, opening balance of shares. This was 400 million. However, when you think of, or when we think of ordinary shares, we also have to think of two things: the ordinary shares as well as the share premium account. So that's 470 million. Okay, and then there was an aspect of bonus shares. Bonus shares. Bonus, bonus. Okay, the bonus shares, we need to know how much were those shares. So I mean, how many were those? So um, we are told that they issued one new share for every 10 shares held. So the amount of shares which were issued were 1 over 10 multiplied by the number of shares. The number of shares available were, we know that the shares available were 400. Okay, with 400. So this is the 400 we are talking about, ladies and gentlemen. So that's 1 over 10 multiplied by 400. This gives us 40 million shares. Okay, 40 million shares. And we are told that they were issued from the share premium account. So we were going to debit share premium and credit ordinary shares. So that movement should be reflected in our working. So we are going to say bonus shares. We can say debit share premium, which means the share premium is reduced by the amount of float, okay, and the share capital, or ordinary shares account is being increased by 40. Okay, then we know there were other shares which were issued, but we are only concerned about the proceeds from those issues, proceeds from share issue. Remember, from the bonus issue, we are not going to receive any cash. Why? Because there was no movement of any cash. They don't entail a movement in cash. They are only given on a non-cash basis to existing shareholders as a motivation for their shareholding. Okay, as some form of thank you, some bonus. So we are told that the balance at the end of the year for ordinary shares was 500 plus 90. So 590. Please replay this video, share the video with your friends and peers and everyone studying accounting so that they master these concepts once and for all. The cash flow is not a problem at all. Okay, so the proceeds. Should be the balancing figure there. So we start with 470 plus, minus 40 plus 40, we still come at 470. However, by the end of the day, our figures had increased to 590, so which means we would have received something. There was an addition there. So 470 minus 590 get 120. So 120 should be our addition. Should be the proceeds from further share issues, because we are told that there were other shares which were issued. Okay, and remember, those shares which were further issued, the amount include the nominal value of the shares plus the share premium. Okay, good. This is why this figure is made up of 500 nominal value of shares, 500 million, as well as the 90 million, which was the share premium. This is the nominal value of the shares, and this is the share premium. Are we together? So the figure we are going to see in our statement of cash flows is this 120. Are we together, ladies and gentlemen? So now it's our time. It's our time. You can pause the video and say, oh, it's now time for the actual statement of cash flows. We have done the groundwork. We've done the working. What's now left is the actual cash flow. Okay, let me just take a small breath. Okay, so ladies and gentlemen, we have just copied the question onto an Excel sheet so that we just do our cash flow statement systematically and with easy. Okay, so I'm going to create another sheet here that is okay, let me just rename it to cash flow. I'll just say SCF. That's the statement of cash flow, okay, abbreviation. And we're going to use the indirect method, okay? That's the most preferred method in the ACCA paper financial reporting, okay? But we have told you how to go about with the direct method, and these methods only apply at the operating activities section of the statement of cash flows. Okay, for the rest of the sections, we just, there is only one investment method. Okay, it's just the same There's no need for using direct or indirect, all right? But the only difference applies on the cash flows from operating activities section. So, as usual, we are going to start with the name of the company on the at the top. That is Lademwinge. Lademwinge PLC. Okay, this is the statement of cash flows for the year ended 31 March 2023. Okay, you're not going to be given marks excuse me, for formatting. Okay, we are only doing this for illustration purposes, but in the exam excuse me, there won't be much time for that. So I don't want you to fail because we're imitating my formatting. So our data is given in millions. Sorry. And you can share them as well. Okay. We have done our workings. We know them. These are the workings, ladies and gentlemen. These are the same workings. And this Excel sheet is going to be given to you. I mean, if you're a registered student, obviously you have got access to this. All right. And for those ones who are not part of our students but would like to have the spreadsheet, this particular spreadsheet, you are free to request on the available numbers. The numbers you can email us directly. Okay, you can WhatsApp us. It's +263 774 596 368. Okay, that's the WhatsApp number. Okay, or you can just email us at transcowlex@gmail.com. Okay, transcowlex, that is CS. You need to include from transcow, then an L, a CS, and at gmail.com. Okay. Now, the first heading to the statement of cash flows is cash flows from operating activities. Okay. Okay, so we're going to have profit before tax as our first figure, and we just take the figure straight from the question. The profit before tax was given, ladies and gentlemen. This was the profit before tax, and just press enter. Okay, then you make adjustments for, then you continue. Okay, what should be our first adjustment? Remember, if we start at profit before tax, then we need to adjust for all the costs and incomes, excuse me, as reported in the statement of comprehensive income or statement of profit or loss. So the first adjustment should be for finance costs. Finance costs. Okay, and remember, these being costs should be added back. So that's equal sign. We go to the working on finance costs. Okay, the finance costs as reported were 47. This includes the dividend, preference dividend, and the ordinary interest from the loan. On the loan. So the 47 is input there. We move on to the next item. Things like amortization, depreciation, etc. impairment. So we start with depreciation. Depreciation. We are adding back, so equal sign. The depreciation, we need to add it back, but as you can see, the depreciation here is in negative, so it is better to put your negative before or just soon after the equal sign, like that, so that it will appear as a positive figure when you press enter, like that. Okay, let's go to impairment of intangible assets. Impairment. Okay, the impairment, just like depreciation, it was a negative, so let me put a negative sign there so that it becomes a positive figure. So 36 Shula. Okay, this adjustment for, let me just try to put it into italics. Yes, that's all, like that. All right, let's proceed to issues to do with profit or loss on disposal, this and that. Okay, was it a profit or loss when those that fleet was replaced? We were told that the trade-in value of the replacement was 14, but the items had a carrying value of 11. So obviously there was a profit of 3 million. So we come to the statement of cash flows and say profits on disposal. Profit on disposal. Since this is a profit, it should appear as a negative, and our figure is in positive, so we put a negative sign there so that when we click the 3, it becomes a -3. Good. Then we move on to things like all right, we need to be informed by the, okay, we've done the depreciation, okay, and impairment. All right, we just want to adjust for non-cash items. Okay, depreciation is non-cash item, impairment of intangible is non-cash item, the issue of profit or disposal is a non-cash item, the item of the issue of grant, the crediting of the grant, this 50 should be considered a non-cash item. Okay, this is for accounting purposes, but the actual grant which was received, we computed it and we now know it. Okay, so this was a non-cash item which should be adjusted for. So grant income credited. The grant income credited should be, since it was a positive figure, should be deducted. Why are we deducting it? Because it was initially added when we arrived at the profit before tax, but because it is a non-cash item, we need to deduct it. This is the reason why we have to deduct it. So we go to the figure. The figure is positive, but we want it to be deducted, so we do what we normally do. Put a negative sign there, press enter. Correct. Okay, do we still have other things before we move on to working capital movements? So we ask the question, we go through the statement of profit or loss to see if we still have other items. All right, we have got this interesting item. Okay, when we did the computation, When we did the computation, we discovered that only of this amount, only 15 was paid. Okay, when we did the working, if you still remember, when we did the working, I just copied these workings from our workings there. Okay, or maybe you prefer to look at the PowerPoint which we used. Okay, let's talk from this particular screen. Okay, so you can see that we determined that the actual amount, although the 67 was the charge to the statement of profit or loss, the actual amount paid was 15 million. So we need then to worry about the non-cash balance. Okay, we need to adjust for the non-cash balance of this particular provision. Are we together? The non-cash aspect of the provision should be adjusted for, because when we arrived at the profit before tax, the non-cash aspect was considered. Okay, think we are right there. So we then have to say, let me try to go back to my Excel. Okay, so we need to deduct 15 from the 67. Okay, plus 67 minus 15. Okay, but in this case we need to say plus minus 15, because the 15 we have is already in negative, so we get the 52. So we need to add back this particular 52. Okay, so the non-cash element, non-cash environmental provision, so equal sign 52 there. Okay, so I'm sure we are done with the adjustments which were required. Okay, so we proceed to the working capital adjustment. Working capital movement. This heading is not mandated, but just for your remembrance. Okay, just for your learning. So we discovered that there was an increase in inventory. If you still remember, increase in inventory. There was also increase in receivables. There was also increase in payables, trade payables. So if there is an increase in receivables, obviously that is increase in assets, in current assets is a negative. Okay, so you go to your workings. No, you don't have to go to the workings because you don't have those working, but to your statement of financial position where you did those workings. Okay, you can see here we've got the working capital movement. So for inventories, okay, they increased from 763 to 920, so there was a 157 million increase. So we want this to be a negative, so just press enter. Okay, it comes as a negative. Here again for receivables, equal sign, we go to the increase. The figure for receivables was this one, just press enter. For increase in trade payables, this should be a positive figure. Why? Because it's an advantage to us. We are being given more time to pay, so it's an advantage, cash flow advantage. So we want that figure to appear as a positive. So if it is already negative, we then have to do that trick. We click the figure and we add a minus sign here at the start, soon after equal sign, and press enter. Then it becomes positive. Okay, then we total up all these figures so that we get what is called cash generated from operations. Are we together, ladies and gentlemen? The cash generated from operations. Okay, so we can use or underline there, and we say equal sign sum, open brackets, open parentheses, something like that. We get 819. We move on to then the interest paid, the actual interest paid, then the tax paid. These two items, you shouldn't forget them. You can't afford to forget them. So these should be outflows. So you say equal sign, you go to your workings for finance cost. Then I have indicated for you that you need to know which interest is going in the operating activities and which one goes to the financing activities of your cash flow. Okay, so you can see here that -8 should be the figure. So you click the figure and press enter. Should appear negative. You do the same for tax paid, equal sign. You go to your tax paid amount, you press enter. Then you underline and get the figure you have always wanted to get so far, 647, and this is what we call net cash flows from operations or operating activities. Okay, you can pull it down a bit so that it is appearing a bit clearer. Then you go to the next heading, cash flows from investing activities. Cash flows from investing activities. Then you can just slot in some information before you look at the question. There are certain things you just need to know, like for example, acquisition of property, plant and equipment. This is normally obvious. Okay, Uh, what else? Um, Disposal, or let me just say proceeds from disposal of PPE. Okay. Okay. So let me try to bolden this, then refer to the question. Your workings should also inform you of what's going on. Okay. So here we can start in the second column, where we say acquisition of property, plant, and equipment. We did this working in the property, plant, and equipment working. This number 4, and we determined that the figure was this much. However, we want this figure to appear negative, so we put a minus sign there, press enter. Then proceeds from disposal of PP. If you still remember, um, the acquisition, I mean, uh, this transaction, let me just explain it looking at the particular note. I hope it is clear, or let me just try to open. Okay. Note number 1. Tangible non-current assets. These include land which was revalued, giving a surplus of 170 million during the period. The Commerce Motor Vehicle haulage fleet was replaced during the year. The fleet originally cost 42 million and had been written down to 11 million at the time of its replacement. The gross cost of the fleet replacement was 180 million, and a trade-in allowance of 14 million was given for the old vehicles. Okay. Um, was there any proceeds from disposal in this particular situation? Was there any information telling us that there was proceeds from from the disposal of this? What actually happened was that the company simply took the old vehicles to the garage, okay, and they were given new vehicles from their garage, okay, but the value at which those items were considered or were recognized at by the garage were was 14 million instead of 11 million according to their records. Okay, this is why we said that there was a profit, all right, because the garage recognized that instead of saying the cars were at the carrying amount, the garage said no, they were still 3 million higher in terms of value. Their carrying amount was 3 million higher than the book carrying amount, which was a profit in a way, okay, but there was no actual money which was given for the for that movement, all right. So that entry for that matter is going to be erased, okay, but it is a common entry in many cash flow statements. It is indeed. So we come here and say no, this one doesn't apply. We delete that. Then you don't have to ask the cash flow. I mean the question. What else? Or even to go to your workings. If you go to the workings there, you can actually get some idea. All right? You can get some idea. Like for example here, government grants received. It's an investing item. So you come here and say proceeds from government grants or government grants received. And this should be a positive figure. So you go side, you come to your workings and say 110. That's your mark. You revisit again your workings, you look for something else that might be of interest to you. These are financing activities. Okay. What about the cash paid on environmental issues? What do we do with that one? What do we do with that one? Okay. Now, for that one, this can be an investing activity. We don't invest in being penalized, because remember that one is linked to a penalty. Okay, so how do we account for this? Okay, I know that when I was talking about the non-cash provision here, which I say that it was 52, if you still remember, a lot of confusion emanated, or let me just say came up. So I would actually have gone a long way to say I would have recognized the full cost here as an adjustment. The full cost was 67. All right, was 67, which I should have added back, and then I should have come here and input. All right, I should have input something like the actual amount which was paid. Let's say it was 15. The actual amount which was paid was 15. Let me put a negative to show an outflow. So you can see if I sum up these two figures, I was going to arrive at 52. So I just put the 52 here, suggesting that I have already taken care of the 15 million which was paid. So please do not be confused. This one we have already catered for it. Okay, we are still in safe hands. We are still in safe hands. Okay, so that one is done. That working has been taken care of. Let's think of something else, something special, something we are forgetting, which is very, very, very important. So let's revisit our workings again to see if there is other aspect of investment. Aha. Goodwill acquired or goodwill purchased of 76. You see that? Good. That's an investing activity. So we come here and say investing activities. Here is your PAL. Goodwill purchased. The wording shouldn't just be similar. Okay, according to your view, maybe you would actually say intangible assets acquired. You were going to get your marks. All right, so that's equal sign. This should be a negative figure, so let us be informed by the figure first. the figure is positive, so therefore we put a negative sign so that it will appear negative. Do we still have any other investing activities? Actually, no more. Okay, so we come to the statement of cash flow, we underline, we then come here and say equal sign sum, press enter, we get a negative figure there. Okay, I don't want this figure to appear there. Okay, it's fine. It's fine. Right. So this is the net cash flows. I prefer to say used in investing activities. Why? Because it's a negative figure. Okay. All right. I give it some clearance so that the examiner will see the figure as quickly as possible. I can as well put this in italics for stylish purposes, for style purposes, to be a bit stylish, something like that. I also wanted to do the same here. Okay, you just have to enjoy the game. Now let's go on to the last part, cash flows from financing activities. Okay, you can bold them up. All right, here we are looking at proceeds from share issue, loan repayments, etc. Okay, so let's start with the proceeds from share issue. The share issue proceeds, you say equal sign, go to our workings for shares. Okay, this was 120 and it should be a positive because the proceed. So what about proceeds from loan notes issue? This was 8 million. That changed if you still remember, but let's get the figure from the workings. Should be positive, yes. And then what else are we going to think of? Yes, the preference dividend paid. Preference dividend paid. Equal sign. Workings. We know we did this on working number 1. This was a preference dividend paid. It should appear as a negative, an outflow. Yes. Okay, seems we are right on it. Seems we are right on it. What about our workings? What's going on? Do you still have anything left for financing activities? We can as well visit our notes for the last time, go through the notes to see if there is any information concerning financing activities or dividends paid to shareholders, other shareholders. During the year LDM made a bonus issue of that much. I think this line needs to be expanded. Yes. A dividend of 220 million was made. All right. The environmental provision needs also to be expanded. Good. So this 220 million was a dividend paid. So we come back here and say ordinary dividend paid equal sign 220. We just have to type it in because it was part of the text, so it wasn't on its own cell, so I need to type it in manually. Okay, but one thing I want you to understand is that we used the wrong column. All right, so let us copy, let us cut and paste in the respective columns. Good. Yes, we copied the formulas, which was fantastic. That's fine. All right, and then we need to get the total here, equal sign sum. Good. So this was the net cash flows from no. Okay, let me finish this. From financing activities. Okay, this one is an outflow because it's amount of money paid. Okay, so you can do as well here. You can spread that row a bit so that it appear a bit clearer. Okay, you can format it in a stylish way, that way. Okay, and the row that comes beneath is the net increase or decrease in cash flows. Okay, I mean the decrease or increase in cash flows. Okay, so that's the the row which we want. So that one is informed. Let me first underline here. It's informed by the total of these figures. Okay, so we can see that it's a negative figure, so that's a decrease in cash and cash equivalents. Then cash and cash equivalents at beginning of the year. This is where I was saying that you need not to adjust for the cash and bank overdrafts amounts during your working capital movements adjustments. Okay, the reason is that these are the figures which we were doing all these cash flows, all this cash flow statement for. So you're going to say equal sign here and look at the opening cash balance according to the statement of financial position, and we can see that the cash was 34. You press enter. Then you come here and say cash and cash equivalents at excuse me, there's a call. Excuse me, I was attending to my kid here. Sorry for that. So okay, here that's at the end of the year. At the end of the year, we were having some amount, but for justice sake, let us compute this figure. This figure which we obtain here, here, should be, I repeat, should be equal to the figure reported by the statement of financial position in 2023. So I'm going to say here equal sign this amount, okay, plus this amount, enter, okay, minus 63. So minus 63 suggests that we have got a cash balance in the negative. So we need to look or to determine if we are having a negative balance in the statement of financial position. And the negative balance is going to be reported as a positive figure, but in the, as a bank overdraft. It is going to be presented as a bank overdraft. Okay? We are in an overdrawn position. So you can say here equal sign, just for reconciliation purposes or for checking purposes, equal sign this amount, okay, minus the closing figure for 2024. And you can see for cash it's 0 there, so you then have to go to the bank overdraft position. So there should be a bank overdraft of 63 there. If you press enter, okay, if you press enter, why is it giving us okay, all right, the reason why it is giving us a negative there, it's mean that okay, sorry, there was something wrong within our formula. Okay, here equal sign sum of these two, okay, that's negative 63, but we want to have a checking mechanism, so we say equal sign this amount, okay, plus the amount here, it should be 0, okay. That's, you need to verify if these two figures, the amount reported by the cash flow should tally with the amount reported by the statement of financial position, which is this one. If you deduct both numbers from each other, they should give you a 0. Are we together? Think I have done all the justice required to the statement of cash flows subject. Okay, I've done everything within my powers to ensure you guys are equipped with the necessary implements, okay, all the necessary information you need. Okay, so how do we conduct our lessons? Some people might be worried and say, how do you guys conduct online lectures? All right, our online lectures are WhatsApp based. supplemented by Google Classroom for organization and so forth of the lectures. Here we'll be having online assignments. You need not to be at our offices. No, you just have to study wherever you are. The online assignments, syllabus specific assignments, syllabus aligned assignments, and pre-recorded videos. Okay, tutor feedback. Okay, there is also an aspect of video conferencing, video calls. Okay, where we'll be doing what we call live streaming upon appointment with the student. Each student has got their own timetable and they studied their own pace. Okay, like I said, you do not need to travel to learn ACCA. Okay, you do not need to have a laptop. You can study ACCA on WhatsApp, on your phone. Okay, so anytime it's tea time, just give me a shout on this number. On this number, that's where we do everything. Okay, so every week there is an assignment. Every week there is an assignment, and our modules are 10-week long. So in 10 weeks, you complete the whole syllabus and you start your revision. This is why a lot of people pass, because we are just exam focused, and you need to make sure that you pass the ACCA while you are in your teen ages. At least you are not more than 30. Okay, most of our students are 22, 25, with the oldest just somewhere around 36. Okay, so we are a young team dedicated to ensure that education is reachable to all the corners of the earth. Okay, so please just give me a shout. I will be there to attend to your queries, to your problems, your ACCA problems, and so forth. All right, so until next time, ladies and gentlemen, may we just call it a goodbye for now. Okay, let us just call it goodbye. All right, you are so special to me. I love you guys. Okay, continue to support me. Don't forget to subscribe, to share, and comment so that we improve. Okay, this is very interesting. I'm signing out. Goodbye.